Now, this next thing to be aware of is something that if you are in a position where you did have under withholding, you could potentially use this tip to help solve that need, but you could also use it to benefit other areas of your finances, and that is utilizing the Social Security bonus. This is something that I say in jest. It's a term we use in the financial services industry. It's not a real thing where you get like an extra bonus for Social Security, but what it refers to is we've talked about Social Security on this podcast in the past, and that you pay as an employee 6.2% in Social Security taxes and 1.45% in Medicare taxes. Now, you owe that 1.45% in Medicare taxes on all of your income. Matter of fact, when you earn certain amounts of money, you pay more than that. You pay a Medicare surcharge on top of that 1.45%. But that base level of Medicare taxes, there's no limit on how much you earn and how much is taxed for that type of tax. However, with Social Security, it works differently. Social Security is 6.2%, but it's only levied against income up to the Social Security wage base. The wage base in 2025 is $176,100, and that means that for someone who earns $500,000, they're paying the same amount in Social Security tax as the person who makes $176,100. It doesn't matter that they make more than twice as much. Everybody stops paying their Social Security tax once they have met that wage base. Now, if you are an extreme high income earner and you earn more than $176,100, what that means is throughout the entire year before you hit that wage limit, you have the Social Security taxes coming out of your check. But once you cross over that threshold, that 6.2% drops off. And that's what's called the Social Security bonus. It's the additional 6.2% that's on your check after you've paid all the taxes to Social Security that are required for the year. This represents a golden opportunity for people who have under withheld on their federal income taxes to take that Social Security bonus and put it towards their withholding for the rest of the year to make sure that their tax bill is reduced. But if you're not in a position where you've under withheld, then you can put that extra Social Security bonus towards other things, like potentially maxing out a health savings account or a 401k or anything that can help lower your tax bill even further before year end. To illustrate this, let's use an example of someone who in the last 2 months of the year is getting a Social Security bonus. They've paid all that they owed from January through October, and in November and December, they get a 6.2% bump in their pay. Now, this is a rough calculation, but by my phone math, in order for someone to be in this situation, they would need to earn about $210,000 a year or so. That is $17,500 per month, and 6.2% of it, that Social Security tax they no longer have to pay in November and December, is $1,085 a month. That means that over the next 2 months, if they have taxes on other portions of their income that weren't paid, they could put it towards those items. But it also means there's an opportunity to repurpose those funds into things like an additional 401k contribution that not only lowers your taxable income and your taxes even further, it also bumps the amount that you're investing towards your own future with additional funds that you have at your disposal at the end of the year. Along those same lines of retirement contributions, you want to have an idea when it comes to not only your investments, but your employee benefits of things that are calendar year deadlines versus things that are tax or plan year deadlines. An example would be a 401k or a 403b. If you're putting contributions into your 401k and 403b, anything that you want coded in the 2025 tax year has to be contributed before the end of 2025. It is a calendar year contribution deadline. Conversely, if you wanted to put money into an individual retirement account and have it coded as a 2025 contribution, you can contribute those funds all the way up until the tax deadline of the following year, meaning that you could have a contribution to your IRA on April 14th that is actually coded as a 2025 contribution if you so choose. It is a tax year deadline. Health savings accounts, flex spending accounts, dependent flex spending accounts. These are other examples of employee benefits where from a contribution perspective, it is a calendar year deadline. But those are from contributions. What about these employee benefits where you can make distributions that are eligible for reimbursement? You'll remember that a health savings account is an account where the funds that are not used roll over from year to year. There is not much concern about you ending the year with money in your HSA that has not been used. Matter of fact, some people never use the funds in their HSA because they plan to use it as a secondary retirement account. However, With flex spending accounts and dependent flex spending accounts, those are use it or lose it plans. If you don't use the funds, there is the possibility that it reverts back to your employer. With a dependent flex spending account, the contribution is a calendar year deadline. If you are trying to distribute it for reimbursement, it may be a calendar year deadline, or your employer may offer an allowance that extends a few months into the next year. And the same is true with your flex spending account. It may be that your plan has a calendar year deadline where if you want to use those funds before they revert back to the plan, you have to do so before December 31st ends. But you will also find that many employers will offer an allowance up to March 15th of the following year to have a withdrawal from that FSA credited for reimbursement in the year prior.